jump right into this explainer. We're going to unpack the dense 20-page statutory financial report for Premier Polyfilm Limited's 2025-2026 financial year. Now, if you follow the manufacturing sector, you know that cutting through accounting jargon to find the real story is absolutely essential. So today, we're skipping the dry tables and translating this company's audited results into a clear, straight-talking health checkup so you can see exactly where they stand.
We've got a tight agenda for today. 1. FY26 revenue and profit. 2. Breaking down the expenses. 3. Following the cash flow. 4. Assets versus liabilities. 5. Shareholder perks. And finally, number 6, the GST tax dispute.
All right, Section 1, FY26 revenue and profit. We're leading with the bottom line up front, and honestly, the numbers here paint a really celebratory picture of growth for this flexible PVC flooring and sheeting manufacturer.
Listen to this number, 33,890 lakhs. That is the massive FY26 total revenue from operations. It's a huge leap from the 30,139 lakhs they reported back in FY25. For a company in the industrial manufacturing space, adding over 3,000 lakhs to the top line in a single year, that's a real game changer. It's a clear indicator of strong market demand and solid operational execution. Basically, whatever they're producing, the market is gobbling it up. And here's the true bottom line. Net profit jumped significantly from 2,600 lakhs last year to a robust 3,188 lakhs for the period ending March 31, 2026. What you should really take away from this is that Premier Polyfilm isn't just selling more stuff, they're actually keeping more of the cash from what they sell. They're scaling profitably, and that's exactly what you want to see. Section 2. Breaking down the expenses. Record revenue is fantastic, for sure, but we've got to ask, what did it cost to make it? Out of the 29,846 lakhs in total expenses, raw materials ate up a massive 17,351 lakhs. The rest naturally went to GST, which was about 4,232 lakhs, and other operational costs. For a PVC manufacturer, this material cost makes total sense, right? They rely heavily on raw material inputs. So if you're tracking this company's future, keep a very close eye on global commodity prices. That specific input is the biggest lever acting on their profit margins. Section 3, following the cash flow. Let's look beyond just the profit figures and see the actual money moving in and out of the business. Because, profit is an accounting concept, but cash is reality. Now, here's where it gets really interesting. Look at the healthy cash generated by operations, contrasted against the aggressive cash used in investing activities. They brought in 2,669 lakhs purely from running their core business. But in stark contrast, they had a net outflow of 2,758 lakhs in investing activities. They are literally plowing their operational success right back into the business. But what exactly are they buying? Well, a huge chunk of that investing cash went straight into expanding physical assets. We're talking almost 900 lakhs dropped on property, plant, and equipment. Now, this isn't money lost, this is money planted. When a manufacturing firm spends this heavily on physical infrastructure, it's a massive signal of confidence. They're building the physical capacity to handle even more future growth. Section 4, Assets versus Liabilities. Let's zoom out to the overall balance sheet to gauge the company's long-term stability. Talk about a strong foundation. They are sitting on over 20,000 lakhs in total assets, which completely dwarfs their total liabilities of 5,442 lakhs for the year ended March 31st, 2026. This translates to an incredibly healthy debt-to-equity ratio of just 0.13. They are absolutely not overleveraged. That gives them a massive financial cushion to absorb economic shocks or fund further expansion without having to rely on outside lenders. Section 5, Shareholder Perks and Dividends. Because what does all this corporate success mean for the people actually holding the stock? Their earnings per share for continuing operations hit 3 rupees and 4 cents. That's a very healthy jump from the 2.48 EPS seen in the previous year. To put that into perspective, for every single share of Premier Polyfilm, the company generated 3 rupees and 4 paise of profit. This cuts right through the aggregate numbers and shows you exactly how their growth is compounding on a per-share basis. And the board wants to pass some of that success directly back to the investors. They've recommended a dividend of 0.15 rupees per equity share. While it still needs a green light at the upcoming annual general meeting, it's a clear signal. Management feels confident enough in their cash reserves to reward their shareholders directly. Finally, Section 6, the GST tax dispute.
We absolutely have to read the fine print by diving into the auditor's report and checking out an ongoing legal issue. No health checkup is complete without looking at the risks bubbling under the surface.
First up, the good news. The statutory auditors gave the financials a clean bill of health. An unmodified opinion is exactly what you want to hear. It means the financial statements are fair, transparent, and comply with all the necessary accounting standards. Investor trust secured.
But, and there's always a but, right? The auditors did flag one specific item as an emphasis of matter, pointing us straight to note number 9 about a tax dispute. Now, this doesn't mean the company cooked the books. It's basically the auditor tapping us on the shoulder and saying, hey, this is important. Make sure you understand this risk before you make any decisions. Here's how the story unfolds. The company had a long-running argument with GST authorities over the tax classification of a product, stretching all the way back to 2017. In February 2026, they actually won a partial victory. The authorities completely set aside allegations of fraud and narrowed the timeline of the tax demand. Now, they have an extended window until June 30, 2026 to take this fight to the next level, the Goods and Services Tax Appellate Tribunal. So they're treating this remaining 98.58 lakh demand as a contingent liability while they prep their next appeal. Based on independent tax advice, they haven't actually deducted this full amount from their current profits. They've only paid the required pre-deposit of about 18.30 lakhs. They firmly believe they have a strong case to win, which is why it remains contingent, an obligation that entirely depends on an uncertain future outcome. And that brings us to our final thought. When you step back and look at this explainer as a whole, you see a company with phenomenal revenue growth, a fortress-like balance sheet, and heavy investments in physical capacity. But that 98 lakh question mark is still hanging out there. So what does this all mean? Will it just be a minor speed bump easily absorbed by their massive cash flows? Or could it become a lingering distraction for management? How might this unresolved legal cloud impact their strategy in FY27? It's definitely the one fascinating variable in an otherwise stellar financial report.